This is Tyson Ray, financial advisor at Forum Wealth Advisors, where we exist to help make life better for our clients and those in our community. This is Forming Perspectives, where we seek to bring clarity to all the complicated information that's out there and simplify it down so we can make wise, educated decisions. First and foremost, there's nothing significant about a calendar year for a long-term investor, especially an investor that has financial goals beyond just their lifetime, meaning you have assets that you're seeking to leave to loved ones and then those assets get to stay with them for their lifetimes. A calendar year is just one of 150, 10, 20, 30 in the plan that you have. But we put way too much weight on them, but yet here we are, we actually have something that doesn't actually happen very often. We have a negative year in the markets. So to clarify, when I say the market, I'm referring to the S&P 500, which is 500 of the largest capitalized companies in the United States doing business all over the world. And so the valuations of those companies from January 1st to December 31st, 2022 were down. And the concern that I have for clients is because it's already happened, now they want to act on it. And that's not really a wise thing to do because it's already happened. I want to talk a little bit about why it happened and now what we're experiencing here in the present to do about it for the future. So why did it happen? Well, let's go back because about 3 years ago, if you don't remember, this thing called COVID was just starting. And it started with toilet paper. Do you remember we actually had a shortage of toilet paper? The shelves were bare and people were stocking up in fear that they were not going to have enough. And then we actually shut down the economy for a while. We never experienced that, and because our government officials had never experienced this, they decided to basically put out money and compensate both individuals that got laid off or weren't able to work and businesses that had to shut their businesses down. They basically gave them money to basically keep peace in our country and keep people from rioting and creating all kinds of panic so they could figure out what they were going to do in dealing with this COVID crisis. And in the end, what we experienced in 2022 was the repercussions of getting too much money in 2020. And one of the things that comes from too much money chasing too few things is something called inflation, which you've been hearing a lot about probably all last year and currently in this year, and you're probably going to hear a lot about it for the months to come. Now, inflation is a problem because inflation means things are costing more. And why is that a problem? It means because if you're on a fixed income or if you have a certain dollar amount to go buy something and the price of that something is going up, you're going to be able to buy less of it. For some of you, I will take you back and think about the first house you bought and what that cost you. And now I want you to think about the most recent automobile you purchased and what that cost you. And for some people, their most recent car costs more than the first house they ever bought. That's what inflation is. And it's actually something that's a phenomenon that when it runs rampant can do great damage to an economy. And what they've been trying to tame, they being the Fed in 2022, was raising interest rates to combat inflation. But here's the thing about inflation from an investment standpoint that I want to reiterate to you as a client that I have known for the last 25 years of my career. For us to beat inflation, which is the goal, by the way, of a long-term investor, is to take the money that you have and invest it in something that can grow your purchasing power greater than the rate of inflation. The only way you can beat inflation is you actually have to beat inflation before you have the inflation. Meaning, the person that's trying to beat inflation now by doing something now, it's too late because everything is already inflated. And we knew that coming out of COVID, and that's why for years we have been overweighted the equity markets, especially coming out of COVID. And as the markets rallied significantly in 2020 and in 2021, inflating the value of our assets. In 2022, because of inflation, the market corrected and we lost some of that value. But on a 3-year time horizon, we actually are still having a positive rate of return. That's in the equity market. You can't say that in the bond market. In the bond market, because interest rates were so low In fact, interest rates were below the actual rate of inflation, which simply means your real return, your return if you owned bonds, and again, we didn't have a lot of exposure to that category. Your rate of return for fixed income for the last several years was actually negative, which means net of inflation, you actually weren't growing your assets. And coming out of the Fed raising interest rates in 1 year like we haven't seen in 20, because we had inflation like we haven't seen in 40 years, fixed income investments, specifically the bond market, had their worst year ever last year. But not only that, one of the concerns I've had for fixed income investors for years has now played itself out. A lot of times people own bonds because they think they're safe or safer. They certainly don't have the fluctuation like the stock market does of day-to-day price changes based on earnings and the economy. Fixed income investments, bond investments, fluctuate based on interest rates because the Fed raised rates so much, it took the value of those bond funds down so much. Not only did they have their worst return in 2022 ever, they had their worst 3-year period ever. And for the first time ever, you actually lost money, not only in a 4-year time horizon, but a 5-year time horizon. To talk about inflation, which is what was driving this, there are a lot of people out there that think inflation has peaked and now we're coming down. The problem is that we're going to probably come down a little slower than people are expecting. And one of the reasons for that is one of the calculations that goes into inflation is not what my wife keeps talking about, which is the price of eggs, which it turns out the last time she bought eggs most recently here, $5 a dozen. That's a lot of money for eggs. We like a lot of eggs in our house, so we're suffering with some of this inflation. And we look forward for that coming down. But that's not probably what's going to need to come down. What's going to need to come down is housing. About a third of inflation is based on the government's calculation of how much a homeowner would be paying if they rented their house. And so if your value of your house has gone up and they went up substantially in 2020, 2021, and now you're factoring that into a rent, those home prices need to come down or at the very least go sideways for a while for it to start showing up in inflation. And in fact, in some areas in the United States, it's expected that home values need to drop about 10% to again bring that inflation number down. But as inflation becomes less and less in 2023, there's a new word that's going to be the new scary word that people get to be worried about. And that's the word recession. And in fact, we're already talking about it because if we actually are in a recession or we end up being told we're in a recession, it will be the most predicted recession in history because everybody thinks one is coming. And what I have found is it's not the recession you've been talking about for 12 months that ends up happening. It's the recession you weren't expecting that actually does more of the damage. And so I don't think that if we end up going into a recession or if someday we get told that the recession started back in whatever they say it started back in, that that's going to be this big shock that it normally is. I think most businesses are actually preparing themselves and have prepared well for any type of recession that we were going into. And again, a lot of times we worry about things that don't happen and we might not end up finding ourselves in a recession. But my point is this, either way, kind of like last year was another calendar year the market was down, whether or not we go into a recession, whether or not the market's going to be down again in 2023 or up in 2023, it has very little to do with what we're trying to do for you from a long-term time horizon, which is the rest of your life for most of you. We're trying to take and understand what your income needs are and then set aside a reserve to fund whatever those income needs are. And then the rest of it, we're leaving them in investments to try and beat inflation. And so if I stop time right now today and ask myself the question I always ask myself, if your entire life savings that we're overseeing was sitting in cash, where should it be? I don't think it should be exposed too much to bonds for the simple reason is the Fed is going to continue to raise rates, and they say they are, then those investments in a rising interest rate environment don't do all that well, as we learned last year. Additionally, if inflation, and it is, currently at 6 or 7%, and the fixed income investments I can get right now, the 10-year Treasury bond is floating around 3.5% or 4%, that return, if my inflation is greater than 4%, is negative. And so again, I don't think that's the place to be. What I think is the place to be is that throughout my entire life, and everybody that's lived beyond the last 5 years, their whole life has been the market goes down, people panic, people get afraid, and then the markets recover. And why is that? It's because the market goes down, the price of these investments, the price of the companies, the valuation of those companies change and go down, and yet the companies themselves haven't changed. The company that you buy your gas from, the company that creates the gas you consume, your favorite soda pop, the type of clothes you wear. All these companies that you consume their products every day sometimes, and when you run out, you run to the store to replace them, or you go online and have them shipped to you. Those companies, their valuations might have changed in price, but at the end of the day, they are run by some of the smartest people on the planet trying to continue to create a product that you want or a service that you want, and in the end, bring a profit for that product or service that you're consuming or using to their shareholders, to which I would rather be a part of, at the very least until the markets go back to their all-time highs, which again, for my lifetime, has always happened. Doesn't guarantee it's going to happen, but if the market goes back to where we are today to where we were January of 2022, that's going to be a great place to be going forward. One of the things I'm getting asked is, are we there yet? Like, how bad can this get? And again, all we have is history as a guide. But as far as a recession is concerned, so since World War II, if we actually are in a recession, end up in a recession, we've gone back and tracked what were the downswings and recessions of the past. And outside of the financial crisis, that I don't think we're going to have that type of recession, outside of the tech bubble, the IPO bubble, the 9/11 bubble, that one, I don't think we're going to have that one either. And outside of the 30s or the 73, 75 recession, where we were running out of oil versus now the United States we actually export it because we have plenty. The average, including all of those, of a downturn in the markets relative to a recession was about, rounded off, call it 30%, 29.9% down. The extreme in the pullback in 2022 was about 25.4. So pretty close. And I actually, if you take away some of these extreme financial crisis, the tech bubble, and the 70s out of the numbers, I feel there's a lot of analysts that feel we might have already priced in everything in this pullback, and now it's just playing itself out, even if we end up going into recession. Because again, the markets are anticipating what's coming, and because companies project earnings out a year, if companies are being priced today based on what they're going to do in the next year, and then all of a sudden Russia goes to war with Ukraine, the Fed starts raising interest rates, those expectations adjusted in that 12-month time frame that we've now lived through, and now everyone thinks things are bad. I actually think people are probably being too pessimistic. And so where we were too optimistic and we created all this inflation, now we might be being too pessimistic and things might actually get better. And in getting better, I think the lows might already be in. We may go retest them, or for that matter, something new might come up that I don't know about, and nor does anybody else on the planet. But likely, these companies will do what they're doing now. Everything they can do to combat inflation, to continue to pay higher wages to keep their workers, to continue to produce products and services, to do nothing but grow those earnings, and those earnings will eventually show up in those equity prices, if history is any guide, is why I'm not too worried about how much lower the markets can go. Additionally, the Fed is starting from a different vantage point, that this rising interest rates and the inflation coming back down gives me the impression that they're probably going to stay higher for longer to keep that second wave of inflation from coming. So I think actually for 2023 and 2024, the Fed's probably going to stay a little higher than people are expecting. I'm waiting for them to tell us, which I expect them to tell us anytime now, we've raised rates and now we're going to pause. Now we're going to watch and see how inflation plays itself out. I don't think they're going to go from one meeting raising rates to the next meeting cutting rates. So if it took 2 or 3 years to show back up, it's probably going to take 2 or 3 years for it to work itself out. So there's no reason to rush or dramatically change our strategy. the best guesses for 2023 is that we're probably going to trade sideways for most of the year, reacting to news that inflation sparked its head or that the Fed paused rates. There'll be good news and bad news as it plays itself out. But what I'm not expecting in 2023 is that we are going to go rushing back to the all-time high of January of 2022. I think that's a year or two out. One of the things that we have to recognize when we have a year that has both a negative return or a low return is that some of our investment strategies or some of our recommendations may need to adjust based on what happened. And what do I mean by that? Well, historically speaking, the markets earn about a 6 to 8% return in the type of models that we recommend. And that's an average, and we don't necessarily get that every year. And last year with the return being negative, we didn't get it. And again, for our clients that live off of that recommended 4 or 5% withdrawal rate that we tend to advise clients on, the portfolio didn't give us the return to generate that extra funds. And so what does that mean? Based on last year being a negative year, what can you do to improve your financial situation for 2023? It actually may be a part of the solution of bringing inflation down, which is to pause some spending, allow the portfolio's opportunity or time to grow back before we go back into those portfolios to pull money out to live off of or to accumulate other things. For two reasons. One, if we don't have to sell with the accounts being down, we'll have more shares to appreciate if and when the markets recover. And two, by going without, we might be able to purchase whatever it is we're trying to purchase at a better price if inflation comes back down and we start finding values again as these excessive prices in both real estate or automobiles or borrowing money become more favorable in the next 12 to 24 months. So as we look out into 2023, let me share with you why I'm not worried about our long-term investment strategy for our clients that will be patient and allow time to pass. And it's because even with the recession, what drives growth in portfolios in the market is often tied to these companies' earnings, which kind of makes sense, right? If the businesses are making more money, then the business that makes more money should be worth more. And though we might have a recession, this earnings, which they track in the past and project out, companies will tell us this is what they think they're going to make next quarter or even out to the next year. And when we look at what the earnings expectations are in 2023, we are expecting that the earnings are going to come down. They're going to be less. Again, why? The Fed is slowing down the economy. But let me help quantify specifically what that is. If we take all the companies that are publicly traded in that market, those 500 companies, and we take all of their shares and we take all of their earnings and we boil their earnings down to earnings per one share. So if we could buy one share that represents all 500 companies, how much money does that one share earn of all those companies' earnings? So in 2021, those earnings went up 49.6%, almost 50% from one year to the next. And then, shockingly, in 2022, they were projected, and they're still collecting the data, they were projected to only grow at 6%. And in 2023, and this is the if we have a recession, they may go down. The number actually for 2022 is expected to come in about $220 for that one share. And then the numbers that are coming in for 2023 are anywhere from 220 flat to maybe about 200. But you hear recession, I hear recession, people hear recession, you would think that number's going to zero. And it's not. A recession is slowing down, or we're not compounding quarter to quarter, but it's not going to zero. It's just slowing down. And yet, when I look at the same analysis from different firms, 2022 is less than 2021. 2023 may be flat, like I just said, and yet some expectations for 2024 is that we would grow about 10% in earnings. And so what am I saying? If earnings are expected to be flat or go down a little bit, well, the market's priced in the down a little bit. That's why the market's off its highs. And so if the earnings are flat for the year, I expect the returns, the portfolios to be flat. which may be better than the fixed income market because if the Fed keeps raising rates, as they did in 2022, raising rates gave them some of the worst returns, worst losses in history. And in fact, history shows earnings grow about 6 to 7% a year over time. Interestingly enough, the market return ends up being about 6 to 8% over time. And so those are the fundamentals that I'm counting on. And yes, this may be a year, or last year was a year that we had to slow down a little bit because of how well we did. But it doesn't mean it's stopping. It doesn't go to zero. It doesn't mean we're not going to consume anymore. For many Americans, this increase of inflation is actually going to increase their Social Security check, and that can be permanent. Additional dollars to spend into the future. But the word recession doesn't mean game over. It means we're resting from the advance that we had. And it's a purification, it's a reset. And there's maybe going to be a lot of people that are going to panic. And there's definitely a lot of people that already have. But I'm not panicking and I'm not worried. And if you are, let's have a conversation about that. And if you have some things that you want to spend some money on that we haven't chatted about, let's have a conversation about that. And see, we just want to make sure what you have is set aside and not bouncing around, because the rest of your life, this portfolio that we manage, to the extent that we can expose it to these markets, is probably, at least historically, going to be the best place for that money to both beat inflation and to leave a legacy to your loved ones. But it's not something that we need to overreact because of rising interest rates, because of inflation, or because of a recession that may or may not happen. What I'm expecting is at some point here in the future, the markets should recover. And I'm also expecting somewhere in the future, the markets will be recovering with the Fed still holding rates higher, and that opportunity may present itself. That's for the money you don't need. Let's talk about what you're really worried about, or what most clients really worry about. What about the money you do need? Again, we're seeking to have on an annual basis an annual review and checkups and checking in to try and assess what are these gaps that you need to fund the lifestyle that you have, knowing that, again, for many retirees, Social Security is going to be increasing and offsetting some of that. And hopefully, like my wife, we're hoping the price of eggs comes back down and milk gets a little more reasonable, or we're going to go buy chickens and a cow. But for some of you that have these fixed income needs, it's to make sure you're communicating to us how those needs are changing and what we need to be doing to address those needs. And for some of you that are accumulators, it's like, the best place to be right now is someone that's saving for retirement or able to dollar cost average. 2022 are phenomenal years of accumulation where money that can go in and buy things that are 10, 20% off allow those purchases to appreciate that much more as the markets recover. And so it's to take advantage of that as much as you can. What I worry about coming out of 2022 are not just the clients that panic, but believe it or not, financial advisors panic. And what happens is they too get scared and they don't know what to do. And so they recommend selling or going into cash. And the problem with that is that you don't have to miss too many days in the markets that the idea of getting out as the market goes down and you've gotten out, it justifies in your mind, it makes you feel like you were right to get out. And that emotion keeps you out. And the studies show that psychology doesn't reverse until you're actually seeing the markets or your investments go back above where you got out. And what happens is it goes from an affirming that keeps you out to regret that you should have gotten back in. And what we try and do for our clients and what we seek to do for those that have made this mistake is to help them realize that if you just wrote it out, what was a temporary decline once recovered isn't a loss anymore. It's only a loss to the extent that you get out and then the markets recover. So what is temporary feels permanent, and yet for my whole life, the market has done nothing but make new highs that may never go back to the lows of my past. And so what is that? That is what seems now permanent feels temporary. As an investment committee, we have a philosophy and a process that holds us to what history shows, that the right thing to do often is nothing. And often, that's the hardest thing to do, which is why it's probably right. We're updating one of my favorite slides, and unfortunately, we're adding the 10th down year in 42 years. And as I said, as I like to say, there is no real significance of a calendar year. It's just a moment in time and a start and a stop, because inter calendar year, in other words, what's the sell-off in any given year, it actually is 19%. We've seen many times the markets have gone down that much. But if you're going to do January 1st to December 31st, this is the 10th time in 42 years that you would have had a down year. What I like to remind myself is, when you look at the down years, they don't look all that scary when you just pull them out and look over the last 42 years of how many times the market went down, compared to the power of what it looks like when the markets go up. So as I want to remind clients, the markets go up a lot more than they go down. The markets historically don't have back-to-back negative years. It's happened, but it's almost as rare as just having a down year. And so if 22 was down, it doesn't guarantee that 2023 is going to be up, but it dramatically increases the odds. So here's my other fun slide, and this is what long-term investing is. What this slide is showing is that in a calendar year, a rolling one-year period going back from 1950 till today, so for most of you that are seeing this, it's your entire lifetime. In any given year, the market can be down a lot or up a lot. And when you look at just that one slide that we're showing you here, this is why people think the market's like gambling. Because you can lose a lot or make a lot if you're focused on 1 year to the next, if you're making one-year decisions with your life savings. But if you have money that you need not for the next year, but for maybe 3, 4, 5 years from now, look what happens when you just go out to a rolling 5-year time horizon. The bottom almost completely falls off, and the top comes down a little bit. If you go out to rolling 10-year periods, the downside almost goes away. And if you go out to 20-year time horizons, meaning if you have money that you aren't going to need for the next 20 years, and maybe you won't live the next 20 years, but then, okay, give that money to your loved ones, and they have 20 plus years, look at your worst and best returns. From 1950 to 2022, including 2022, the market lost 19% of its value, and yet your total compounded return still averages over 10%. That's the growth or the power behind these companies growing their earnings and having people that want to consume or use their services. So first of all, you should thank the people on my team, because I have so many more slides and things that I would like to go over, but they tell me that's not what you want to hear. What you want to know is that we're paying attention. And what you want to know is that we're following research, and not just one company's research, or not just my opinion or Luke's opinion or Christine's opinion. We are taking a lot of different opinions and finding out how they harmonize. What we're doing is we're taking in facts, and we're taking in comparisons, and we're taking in understanding. I seek out experts. We seek out the information to bring in an understanding to make an educated decision, to make unemotional decisions, because that's the type of advice you need when you're trying to make a decision on what to do with your life savings. And so it's our privilege, and so thank you for letting me share some perspectives with you, and feel free to share this with somebody else who you think would benefit from seeing it.